You're listening to Business Insights by BPM, a podcast series in which top-of-mind business imperatives are discussed with the brightest minds in the profession, offering world-class solutions. Each episode will bring you conversations with world-class industry leaders from financial services to technology. Subscribe and listen to each episode of Business Insights by BPM wherever you get your podcasts.
Hello, I'm John Weems, Head of Business Development with BPM, and I'm here today with San Francisco-based James Lichau, partner and co-leader of our firm's financial services industry group. In addition to that and his day job, he also happens to be an experienced race car driver and weightlifter, but we can cover that another time. James, good to have you here today.
Hi, John. Thanks. Good to be here.
So, James, as we get started, would you mind sharing just a little bit about your background in terms of some of the types of FinTech companies that you've had an opportunity to work with through the years?
Yeah, sure. Well, BPM over the last 10 years, I've worked with peer-to-peer lenders, traditional balance sheet lenders for alternative consumer credit products, credit card issuers, and some payment processors.
Okay. And, we understand that it's a time with a lot of movement in the markets. A lot of companies have been on a bit of the roller coaster ride within FinTech. Can you talk a little bit, for starters, about what you see on the M&A landscape for FinTech in the next year?
Yeah. No doubt it's going to be a challenging time for the FinTech space coming up. I think the companies that were planning on raising capital in 2023, they might look to pull back on those plans, just given the fact that the valuations are down. And, when valuations come down and they go to raise capital through like an equity financing, the dilution to their existing shareholders tends to be a little bit more than what they want to stomach. So they might, look at restructuring the company, reducing headcount, maybe putting off projects or launching new products, just to extend that cash runway as long as they can until the markets kind of right themselves. But on the other hand, the folks that are cash rich and have opportunities in terms of acquisitions to grow their business, I think we're going to start seeing some of that too, because on the flip side, they're going to take advantage of these low valuations and start to bring in other companies that can help them diversify their product base.
And you touched on this a little, James, but for those who maybe aren't quite so fortunate and cash rich, what funding options do you see for those who are more in raising mode? Yeah,
so I touched a little bit about, the equity financing. There are, I'm still seeing some debt financing occur. A lot of times though, in these markets with the higher interest rates, not only do you see expensive debt, but you also see debt with sweeteners like warrants or very beneficial conversion prices for like convertible debt or safes. Another option that I've seen is not so much even on the financing side, but some of my clients have pivoted their models, right? So speak from a FinTech lending perspective or a lender perspective, I've seen these companies move away from like the traditional, like the leveraged lending models and partner with banks to where they really are just like an origination engine. And this allows them to obviously realize the earnings from their origination fees that they get almost immediately, but it also kind of uncaps their borrowing ceilings that they would have otherwise had on their debt. And so it really allows them to scale quite large. The flip side is sometimes they get acquired by the banks too, if they go that route. And then that can sometimes, maybe not allow them to travel down the path they wanted to, or, that they intended to when they started the business, but it also can help them really grow and really use the models that they've built over the years to really get to the market or the borrowing market that they intended to originally.
Anything else on the scaling front, James, for the companies that do persevere?
Yeah, and it kind of ties in, John, with some of the pulling back, right? So some of these companies that are going to want to pull back on operations, maybe they decrease headcount, maybe they divest the business line or certain assets, or put off projects. I think what we're going to start seeing, and this is what I've seen some of my clients do, is a much heavier use of AI tools and machine learning. And another component or tool that I've seen folks use is what we call robotic process engineering, or RPA, which really allows like computers and software to handle routine, simple tasks that either are going to allow them to reduce the headcount or take some of that routine time that employees spend doing their jobs, take it off their plate and allow them to do a lot more meaningful work. And, there is an investment in it, but it's becoming a lot more prevalent in the market. And I think that's a large way of how these folks are going to really fine tune their operations and their cost structures as well.
Well, James, thank you. I've experienced firsthand how you interact with clients and helping them navigate turbulence or times of great flight. Appreciate you being here with us today. Thank you for your time.
Excellent. Thanks, John. Appreciate it.
We hope you enjoyed this episode of Business Insights by BPM. You'll find links to any resources mentioned in today's show notes. And if you'd like to learn more, visit bpm.com/business insights. Thank you for listening, and be sure to subscribe for updates on future episodes.